Fundamental Analysis, Part 1. Fundamental analysis is the analysis which tells the health of the company. Intrinsic value is the price with which the stock of the company should be sold under the normal conditions. If the stock is selling at low price, then it is good purchase. If it is selling way up the price, then it is overpriced. All these can be found in any financial websites like Yahoo Finance, or Trade, or Macro Trends. Note: the website which I have mentioned above are just some of the website. There are many website, or you can directly Google the values also. Some fundamental stock measurements are presented in next slides. Number 1. Cash flow per share. Cash flow per share is simply a cash flow through the company divided by number of shares outstanding. The more positive it is, the more company is getting what it is selling the products. They are getting the money. Cash flow per share is equal to total cash flow divided by number of shares outstanding. Here's something to note, is that cash flow per share is cash left after tax earnings plus the depreciation on per share basis. That functions as a measure for company financial strength. Many analysts favors cash flow per share than earning per share. The reason being that we can manipulate the earning per share, but cash flow per share is the hard number which comes after deduction of tax and cannot be manipulated. Note to listener: look for the company which is having positive cash flow. Number 2. Current ratio. Current ratio is equal to current asset divided by current liabilities. Current asset can be cash, inventory, account receivables. Current liabilities can be everything that it owes, like loan, bills and such. Current liabilities are the ones which are due in 1 year. Note to listener: the more the current ratio, the better it is. More current ratio means that company have more assets than liabilities. Look for a company which is having at least ratio of 2:1. Number 3. Dividend yield. Dividend yield is equal to annual cash dividend divided by current price of stock. Example: suppose company's quarter dividend is 15 cents. So annual dividend is 0.15 times 4 equals 0.60. And stock price is $15. So the dividend yield is 0.60 times 100/15, that is 4%. Now suppose stock price changes from $15 to $30. So dividend yield is 2%. So dividend yield, or you can call DI, tells you more about stock price than the dividend. The reason being that the dividend always remains constant, but the stock price keeps on changing. It may also means that stock may be becoming overvalued, since dividend yield is decreasing. Now you may think that increase in dividend yields tells you that the stock is on sale. It is correct, since the large companies pay dividends, and increase in dividend yield tells that stock is for sale. For example, in above, suppose the dividend yield is 2%, and it increased to 4%. Which means that the stock which was earlier high price is on sale now. Note to listener: if you look from other side of mirror, higher dividend yield also means that stock price is declining, which may also tells that company may not be doing good. That may be the reason that investors are losing interest in the company. Look for other parameters like debt. Companies in the utility and consumer staple industries often having higher dividend yields. Real estate investment trusts, REITs, master limited partnerships, MLPs, and business development companies, BDCs, pay higher than average dividends. However, the dividends from these companies are taxed at a higher rate. Number 4. Earning per share. In short, it is also called as EPS. The formula for EPS is company earned during quarter or year divided by total shares outstanding. Here one thing important to note: that EPS is subject to manipulation and market pressure. Every company wants to show the strong earnings, because strong earnings means more people are buying the products of the company. EPS remains a useful measurement. The bigger the number, the better it is. The more company earns, the more desirable it becomes. If more EPS, then more raise in stock price. If the EPS is increasing quarter after quarter at a faster rate, then it is called earning momentum, or earning acceleration, and it is a popular way to identify the growth companies. Earning surprises is the quarter EPS showing either higher or lower EPS. This is used to track the trend early. Number 5. Net profit margin, also called as NPM. Net profit margin is equal to money left over after paying all the expenses divided by amount of money it had before paying expenses. The net profit margin illustrates how much of each dollar in revenue collected by a company translates into profit. Net profit margin is typically expressed as a percentage, but can also be represented in decimal form. It is the ratio of net profit to the revenue of the company. Note: high net profit margin means company is good. But again, it depends on industry. The retail companies will have less percentage of net profit margin. Here we will take example of two companies. Example 1. Company A. Amount of money it has before paying expenses is $1 million. Total expenses is $900,000. Money left over after paying expenses is $1 million. 1 million minus $900,000 is $100,000. NPM will be 10%. Example 2. Company B. Amount of money it has before paying expenses is $1 million. Total expenses is $700,000. Money left over after paying expenses is $1 million minus $700,000 is $300,000. So NPM is 30%. So which company you will take? Obviously company with NPM of 30%. Net profit margin also tells about the good management, which is taking all the measures of controlling costs. The end. Thanks for watching and please subscribe my channel.